tax season, and here's what you need to know. Hi, my name's Josh, and in this video, I'm going to change your life with some easily missed tax deductions that can maximize your return. But first, let me cover some important information that you need to know before filing your taxes, and if you already know this stuff, feel free to skip ahead to the deductions. So deadlines. April 18th is the deadline for all federal taxes. It also happens to be the deadline for any contributions for last year's IRAs. If you're like me and you want to file as early as possible, don't forget that tax documents become available on February 15th for most brokerage accounts, and you'll need those if you trade or invest. If for whatever reason you need to file an extension, the deadline for that is October 16th this year. Alright, so filing status. When it comes to this, it's important to know what category you best fall under. So you're either going to be single. This means that you're either not married or you're legally separated as of December 31st of the filing year, and you don't qualify for another status. Married filing jointly, you got married on or before December 31st of the filing year, and you and your spouse file a joint return together. You continue filing this way each following year unless you decide to file separately or you become single again. Married filing separately. With this one, you're married but you don't file jointly with your spouse. With this, instead both of you file separately and are only responsible for your own income, deductions, and credits. Be careful with figuring out who's going to be claiming dependents if you're in this category. And then the last one, head of household. If you're single and you've paid at least 50% of your expenses to run your household, and you have a dependent or dependents that have lived with you for over half of the year. Alright, so brackets. Now that you know what filing status you fall under, let's see what bracket that puts you in. Here's a chart of 2022's tax brackets. You can generally expect to pay the percentage associated with each bracket on your taxable income. Next is a chart for 2023. Just because you're in a tax bracket doesn't mean that you're going to pay the rate that's within it. The tax bracket only really applies after deductions are made to lower your overall taxable income. And if you watch this video to the end, I'm going to give you a list of 9 of these deductions. You're not going to want to miss out. Alright, so documents. Some of the documents that you need before filing include your W-2, the wage and tax statement, the 1095-A, the health insurance coverage, 1098, your mortgage statements, 1040-A, plus any of the receipts for write-offs, 1099-B, your brokerage statements, and or 1098-E, your student loan stuff. And in the description below, I got a complete list of the tax forms that might apply to you and instructions how to fill them out. Up next is credits and deductions. Tax credits are like coupons that will lower your final bill, while deductions will lower the overall amount of income that can be taxed by the government. There's a common misconception when people tell you to eat an expense and just claim it on your taxes, but it really doesn't work that way. Like, you're not going to get refunded the money, it's just going to be able to be claimed and lower the overall amount of income that can be taxed. So if you deduct those expenses and it doesn't really lower your tax bracket, and it didn't do anything, and you just got played. Most people file with the standard deduction, and you should only really do the itemized if you can total up more itemized deductions than what the standard deduction is worth. I'm not a financial advisor, so I highly recommend you talk to a tax consultant if you want to see what you can and can't deduct. I've also got a link down in the description that'll show you all this if you want to research it for yourself. Alright, so let's talk about those deductions now. Number 1, charitable donations. And this includes cash or non-cash donations to a qualified charitable organization. Examples of cash donations include donations to churches or a GoFundMe charity, as long as it's not a personal fund, because those are considered gifts and they do not qualify. Non-cash donations include stuff like clothing, equipment, furniture, computers, stock shares, etc. However, if you itemize non-cash deductions for items over $5,000, the IRS requires you to provide a qualified appraisal for those items. Also, make sure to get your receipts for any donation under $5,000 for in the event that you do get audited. This information can be found in IRS Publication 526 for more details. Number 2, vehicle sales and property tax. If you buy a new car, an RV, or a boat, you can deduct the sales or property tax on these registrations. State and local, or SALT, deductions are limited to $10,000 and include property, sales, state, and local taxes. These are 2 separate write-offs that you can file on Form 1040-A, so pick the one that gives you the better savings at the time. Number 3, home deductions. And this may be one of the biggest deductions you can have if you own a home. One of the bigger benefits is that you can deduct the mortgage interest payments, and here's an example of that. You're able to deduct the mortgage interest for the first $1 million if you bought your home before December 15th, 2017. If you bought your house after December 15th, 2017, you're able to deduct the mortgage interest for the first $750,000. An example of this is if your mortgage was $900,000 with a 3% interest rate. You can deduct the $27,000 in interest payments if you bought before December 25th, 2017. If you bought the same house for the same price in 2019, you can deduct $22,500 in interest payments. You can also deduct home equity loan interest, sales tax, mortgage interest, or PMI, as well as other things. But you'd want to get with a tax expert to make sure they qualify first. Residential tax credits. Solar panels are primarily a way to reduce your monthly electric bill, but you could also get up to a 26% tax credit on the installation cost as well. This is going to expire in 2024, but there will likely be more of these solar tax credits, especially with the United States' move towards renewable energy. Number 5, educator or education expenses. You can deduct the student loan interest, payments, tuition, room and board, books, and other necessary items on qualified loans. You'll use Form 1098E to show these expenses and need to provide receipts for the items not shown on it. And if you're an educator or teacher, you can deduct $250 on classroom supplies. Just don't forget your receipts. Number 6, investing into a 401k or an IRA plan. If you're not familiar with 401ks or IRAs, check out the video that I have pinned in the comments below after you watch this video if you want to learn more about the stock market or investing. A 401k is a retirement account that is usually provided by an employer that they may pay into or match a certain amount of your contributions. And an IRA is an individual retirement account that you can set up for yourself. Every dollar that you invest into a 401k or IRA can be deducted from your taxable income. This does not apply for a Roth IRA, so only deduct from a traditional IRA if you have one. There are limits to how much you can contribute to these accounts every year, so best advice is to max these out before investing in a taxable account. Number 7, medical expenses. You may be able to deduct qualified medical expenses if they're more than 7.5% of your adjusted gross income, or AGI, and you'll do this on Form 1040. Example being that if your AGI was $75,000, any expense over $5,625 could be deductible. If you had a qualified medical expense of $10,000, you could write off the difference of $4,375. Some of the more common examples of qualifying medical expenses include, but are not limited to, payments to doctors, surgeons, chiropractors, and other medical practitioners. You can also deduct hospital or nursing care, prescription drugs, insurance premiums for medical care, as well as many others. You can get the full list by looking up IRS Pub 502, and I got a link to that in the description below. Number 8, health savings accounts. HSAs are tax-exempt accounts that can be used to pay for medical expenses. Money that you contribute is tax deductible, and it caps out every year at $3,850 for self-only coverage and $7,750 for family coverage. An HSA is not only a tax advantage account, but at some point in life, you will likely need medical care. So this is a great way to save up for those expenses later in life while saving on taxes right now. Number 9, child-dependent tax credits. Some of the key qualifications that must be met to earn this credit include the child being under the age of 17 at the end of the year, they've lived with you for more than half of the year, they're properly claimed as a dependent on your tax return, and they're U.S. citizen, U.S. national, or U.S. resident alien. At the time of filming, the maximum tax credit per qualifying child is $2,000 for children 5 and under, or $3,000 for children ages 6 through 17 years old. I've got a link for the full list of IRS deductions in the description below. And if you're worried about getting audited or fined for filing your taxes wrong, watch this video next to see some of the things that you need to avoid. And if you found this video useful, consider subscribing to help me continue making content like this.